Hi everyone. Thanks so much for joining. It's a Market Live for our NFP Live event, and it's a Wednesday. Yes, there was another government shutdown. We're normally used to these on a Friday, but they've been happening on odd days in recent months. But anyway, US federal government craziness aside, let's go straight into the charts where we're just looking at world equity markets, just to give a flavor of what's going on. Markets are really, in Europe, certainly, they're a little bit to the downside. Obviously, the FTSE 100 is rallying on the back of some good news. The LSE in particular, in the LSE, which is giving hope of a bit of a turnaround. Let's take a quick look at US equity futures. Just bear with us there. As you can see, they're pointing higher, actually. Not too bad. They've been oscillating, but around these kind of, 10 points for the S&P 500, 30 to 40 points for the NASDAQ, E-minis. But by and large, they've been positive all day. Take a quick look at bond yields. We're not expecting them to go anywhere, but yeah, bond yields, sea of green. That means yields are falling, bond prices are rising as we lead up to this data. Now, in terms of the data, we have 4 minutes to go before it comes out. Let's just run through what is expected here. So we've got the headline payrolls. If you just follow my pointer here, you'll see 65,000 is expected. That would be the highest reading in 4 months. However, it comes off some fairly weak readings actually that we've seen. So we're looking for a number of 65. I think the sweet spot between that would really have major impact on financial markets is between 60 and about 100. If we get between there, then I expect market reaction to be fairly limited, and that would be kind of been seen as the essentially a continuation of current themes. So would be good news for stocks, basically, but not maybe a knee-jerk higher. We've got the unemployment rate, if you follow my pointer down, 4.4%, so no change in the unemployment rate expected. And we've also got average hourly earnings, 0.3% rise for January on the month. You tend to see a bit of an increase in January, 3.7% annual, down from 3.8% last month. So the annual rate still well above inflation, but kind of contained. I think everyone will be happy with that if it comes in line with expectations. But the big thing to watch out for are these benchmark payroll revisions. They've come out every year in January, and they are, although I realize it's February now, they come out with a January payrolls report, and they are a revision of all the 2025 job numbers, minus 825. Now that is huge. Do you know what that would mean if that comes in line? It would mean there'd be basically no job growth in the US last year. What's really weird about that is that we're not in a recession. A downgrade of jobs to this extent is very recessionary. Now, there are a few reasons for that. You've got the birth-death ratio is being recalibrated, so that will have an impact on it. You've also got basically, immigration has been halted for the past year, so that's really playing into this as well, that there's just less people to do those jobs. It's not that the economy is weak, it's that immigration is having an impact on the jobs, or the lack of immigration, I should say, means that there are fewer jobs out there. So that's really going to be worth looking at. It'll be interesting to see how the market reacts to that, because it could definitely speak to a much bleaker jobs market, particularly if we get weaker payrolls for January and also a rise in that unemployment rate. So we're just going to be waiting to see exactly what's going on. Now, just as we lead up to that, let's take a quick look at gold as well. Gold very comfortably now above $5,000, but it has backed away from that 5,120, and we're just up $60 so far today, trading just below that 5,100 level. Remember, if we do get some weak payrolls, that would boost expectations for rate cuts from the Federal Reserve, which would also make gold slightly more attractive, I think, because of any underlying inflation concerns, although this is a blockbuster week for US economic data. We had retail sales very weak yesterday. We've obviously got the labour market report today, expected to be I think it's the revisions that are causing the weakness in this reading, and then of course we also have CPI on Friday. So they're a troika of really important market moving data. In terms of what moves the most on the back of this, it does tend to be payroll. It does tend to be treasuries, and that can really move to quite a big way. But remember, treasuries also impact the dollar, and if borrowing costs go up or down, that also has an impact on equities as well. So it's definitely something worth looking at. But yeah, treasuries is where we tend to see that, and we'll be watching those closely. Now we've got just under 30 seconds before we get this data. Just as I mentioned, blockbuster week for economic data in the US this week. We had weaker retail sales, which has really shed a bit of concern about the consumer in the US. We did see bond yields fall quite sharply yesterday, and we also saw interest rate expectations get recalibrated a little bit higher, so more rate cuts now expected. 5 seconds to go before we get this data. Let's take a look at where we are. Here we go, just waiting for it to come out. Let's see. Oh, it's a little bit delayed. Underemployment rate is only 8%. Wow, that's a big, oh goodness, a decreasing unemployment rate to 4.3%, 130,000 increase in payrolls. That's huge. We're still waiting to get the benchmark revisions, but that is a huge move. So much stronger than expected payrolls, double actually what was expected. Decline in the unemployment rate, a decline in the underemployment rate from 8.4% to 8%. This is amazing. This is a really strong report. Let's take a look at that. Yes, this is the 10-year bond yield shot right up. As I said, that really is higher. That's gone up by 7 basis points right now. That's a big move on the back of this. Let's take a look as well at the dollar. I would expect the dollar to move higher as well. A bit of a slow reaction in the dollar, but I do expect the dollar to move higher. Remember, the dollar has been everywhere today. It's been down testing the lows of the day, and then it picked up as if it was pricing in better than expected data. Let's take a look at what gold spot is doing as well. Gold spot is lower. Yeah, so as I mentioned, less chance of rate cuts. So we will also look at that work chart to see what's going on there. But right now, less chance of that going on. That's interesting. Let's see what futures are doing as well. Just bear with me. Oh, futures on the upside. Remember, yesterday we saw some weakness. We're seeing a lot of pockets of weakness in stocks at the moment as the AI trade causes a lot of existential angst for people, for investors. But we also yesterday, one of the reasons why stocks were a bit weaker and underperformed other global markets yesterday in the US was because of the fear about the economy. Now, we don't seem to have that at the moment. As you can see, we've seen a big uplift in equity index futures. So look, 78 points on the Dow, 12 points on the SP 500 and 43 on the NASDAQ there. So a bit of an increase there. Still fairly small moves on the day, but something worth looking at there, that the market is liking what they're seeing. Let's just take a look at that dollar. The dollar index seems to be stuck around that 96.75 level. But let's just take a look at dollar yen, because remember, the dollar has been really, really weak coming into this meeting all week. It's dropped like 1.7% against the yen. Has it been able to turn around some of that move and claw back some losses? Yes, it has. Back at the highs of the day, so back testing 154.50, well below those lows. You know, it wasn't that long ago that we were looking at a move to 160, well below there, but certainly 155 could be on the cards now on the back of this economic data. So much stronger data. Let's see where we are. We still haven't got the revisions out yet. If we just look at the trade, if we go into the data, just to see what's been going on here, just bear with us all. Sorry, my system is a little bit slow. But as you can see here, is this December? Yeah, as you can see here, right. So this is 130, this is January. If you follow my pointer here, you'll see what's going on. Professional business services, they were hiring. Education health services, they've been a long-term hirer, so they were stronger. We've also got financial, where does that? Yeah, financial activities, that was stronger. Government was weaker. We did expect that, actually. That was government, obviously, they froze high. They're kind of freezing hiring, really, in some departments. So that is expected, a decline of 42,000 jobs in government. But we've seen increases elsewhere. Now, that is very, very positive, particularly in education and health. Construction as well, that's very positive for the economy overall, and of course those professional and business services. So a really broad array of job growth here, which I think people will see as being maybe 2026 is turning a corner. Again, I'm just going to keep a quick eye on those revisions because I would like those to come out. 862, so down 862,000 jobs, pretty much no job growth in 2025 then. That's what that means. But we've got this very low unemployment rate. I mean, 4.3%, we're going back to, early 2024, 2025 levels for the unemployment rate here. So this is much stronger. So kind of a difficult report to read. It suggests that we were very weak, very bleak looking labour market for 2025, although that could be caused by immigration, as I mentioned. And then on the upside, a really strong start to 2026. So maybe companies scaled back their hiring too much in 2025 because of AI fears maybe, or other things going on top of the immigration issue that we mentioned. And maybe they're kind of making a bit of that up now. Now that is really, really interesting. As I said, it's really leading to a big market reaction. So the gold price has stabilized. It had gone down to 5,020, had been up, but that's nearly $100 lower from where it was. It's given up more than half of the gains just before we came on live here, and it's now making up a bit of those losses, but still quite close to the lows of the day. Let's take a quick look again at the 10-year yield. 10-year yield is actually extending these highs now, back testing 420. That's roughly been where it's been actually for a while. So it's not breaking new ground, but it is clawing back those losses, the decline in the yields that we saw yesterday. So yields are climbing on this. Obviously, let's take a look as well in our world interest rate probability. That tells us interest rate probability for the Federal Reserve. Yesterday, we saw a big recalibration where there was almost the markets were just under pricing for the first rate cut to come in April. Now, this typically takes a bit longer to come through. So this we may not be able to show this right now or see too much, but we are currently still expecting 2.5 year, just under. So it is recalibrating now. So there were 2.5 rate cuts expected, is now about 2.4. There's now rates are expected to end the year at about 304. It's about 303 yesterday. It's not a massive change here. Obviously, we do also need to see what's going on with the CPI report, which will come out at 1:30 on Friday. But certainly there seems to be something going on. So we've got this very weak data in 2025, much stronger than expected data in 2026. It's a hard one to read. But as I said, there's quite broad-based growth, but that old reliable education and healthcare, they are driving gains in payrolls. As I said, this is quite a sweet spot, this 130. Actually, it was a bit more actually than what I expected. It's, I was saying anything over 100 would be a bit of a sweet spot. I think 130 is okay though. I don't think that's going to be seen as being overheating the economy, particularly since we lost so many jobs last year. That dropped in the unemployment rate though is really, really interesting because a lot of people have been saying, how can there be no job growth and yet unemployment has not really significantly ticked higher in the US? So this is just adding to this strange cycle that we're in, whereby it's a low hire, low fire environment, but obviously the hiring has seemingly picked up. Now, typically, a strong payrolls report, things that we see during a really strong expansion, is like 200,000. So we're not anywhere near that yet. But it is worth noting that Q4 growth is expected to come in at 2.9%. We'll find that out next week for the US. Also, Q3 growth is really strong at 4.4%. So, essentially there is no good job growth in the US last year, yet the economy expanded massively and the unemployment rate remains very low. So it's low hire, low fire, but obviously that's shifting a little bit today. Let's take a check up at highs of the day around 154.50. Certainly recalibrating the dollar a bit higher this, and it's obviously recalibrating the bond yields higher as one would expect, and also and we've also got equities moving higher. So let's just take another look, see if that's still the case for equity futures, because remember, US markets, they're not quite open. They don't open until 2:30 GMT. Yeah, so we're still seeing them hold on to those gains, really. 80-point gain on the Dow. This is good news. So a solid economic read, a solid labour market reading, really, and an upside surprise on the top of that. It definitely does suggest that we are, the labour market was bleak last year, but it's not all terrible and doom and gloom. And there's, consumers have still got jobs, and they're able to hold, they're still going to be able to spend. So really, it points to maybe a slightly brighter future. Certainly some better than expected data, and sits more in line actually with some of the survey data that we've been getting from the US to show that, actually after really strong growth in 2025, the labour market might be turning a corner in 2026. Obviously, we need to see more signs of that. One data does not make a trend. So whilst we could recalibrate higher, and maybe we've got a floor in where interest rates are expected to be, it's going to be hard now to get that third rate cut priced in on the back of this report. And obviously we need to see what CPI does, but I think if CPI stays above, around about 2.5, 2.7%, it's going to be very hard to price in a third rate cut. Now that's dollar positive, it's also negative for treasuries, but it could be quite positive for stocks because it's a better economic outlook. But guys, this is, as always, such a pleasure to have you for this live and to be able to see this wonderful economic data release with you all. Thanks so much for joining, and please do follow us on our socials, XTB